Well, good morning, John. It's good to see you. In the last few days, we've flirted with new all-time records, although yesterday was a bit of a sell-off. We were reporting this on Wednesday morning. John, there was an interesting bit of research out from Goldman Sachs. David Costin, their chief strategist, has suggested because the market is so high, they do projections for the next 10 years. And he's suggesting that although in the last 10 years, the S&P 500 returned something like 13% per annum, because the market is so elevated and also so concentrated in the mega caps, he's expecting only a return of about 3% per annum over the next decade. Of course, that doesn't apply to Australia, and these forecasts may not be particularly useful from a timing point of view. But do you have any comment about that? Do you think we should expect lower returns from equities over the next decade?
Well, arguably, if the last 10 years has returned 13% and the average long-term run is 8 to 9, then you can say the next 10 years will be 3 and make it 20 years equals 8 or 9. So that's what they're doing. Yeah, I mean, it's mathematics. I think it does suggest, though, that markets are very elevated. P's are very high. You can look at that return of 13% and work out how much is actually earnings driven and how much is being PE expansion driven. I think in the American market, there's a lot of evidence to say it's being earnings driven more so than, say, places like Australia where it's been PE expansion. We've seen that very significantly in the banks, whose earnings have hardly grown, yet their share prices have rocketed through PE expansion. So I take the point, but 10-year forecast, Paul, I don't really get excited about. I think all we can do is focus on the short term or medium term. 10-year forecasts will come and go, and no one will remember them in 10 years, Paul. So
yeah, and I think the point could also be made that this is for the S&P 500, which at the moment is very much dominated by the 10 largest big cap tech names. And for them to carry on growing at the huge pace that they have, it becomes arithmetically impossible to carry on at the same pace forever. So that's perfectly understandable. Whereas here in Australia, the market isn't as concentrated, and also there is the opportunity for us who don't necessarily follow an index to focus on those overlooked stocks, the value stocks, stocks which are perhaps underpriced relative to overall indices. So there's obviously that opportunity for us here in Australia. The other point that I wanted to ask you about, just recently we have seen a tick up in bond yields. In Australia this morning, I think the 10-year bond is sitting at 4.4, which is a big rise from the 3.6 it was, perhaps a month and a half or 2 months ago. Is that a threat to the market, or do you think that's just trading within a range? Were you seeing the bond rate as keeping a lid on the market, or just people resetting?
I think they should keep a lid on the market. I think the rising bond yield. There's always two sides to the story. One is a rising bond yield suggests that the risk of recession has gone away. Recession talk in Australia is not existent now. And despite that, we're still talking interest rate cuts as inflation trickles down. But your point is right. The risk-free rate of return rising does normally put a cap on PE expansion. But your other point was true as well. It's in a trading range, and the Australian 10-year bond has traded between mid-3s and high 4s for the last 2 years. We're in the middle of that range again. But I think it is symptomatic. I think the important point is that the yield is rising as the risk of inflation and the risk of recession dwindles away. I think 4.4% 10-year bond, it's about 0.5% to 1% above recent inflation readings. That's fair. That's where it should be. So none of this is exciting, and none of it is a worry. It's just markets moving back to where they should be after many years of manipulation through quantitative easing right around the world. And we are seeing interest rates cut aggressively across the world, Paul. We've got an ECB cut coming, Canadian cut coming, New Zealand's cut aggressively. All those banks which pushed up interest rates aggressively are now having to cut them aggressively. And Australia didn't put up its interest rates aggressively. And I think people may question that, but historically we're not at high rates, 4.3%. So we will cut in the new year, no doubt about it. The question mark is inflation, which I don't think is as sticky as a lot of people say. Australia is a manufacturer of inflation. The way we run the economy, we embed inflation. A lot of businesses traded off inflation, toll roads, and we have this adjustment to taxes on inflation. It's quite bizarre.
So that's really interesting, because I think I read this morning that out of 40 developed countries, Australia has something like the second highest rate of inflation. So it's come down everywhere. In fact, in the UK and in Europe, it's actually below target rate now. But Australia has seen inflation lingering and been very slow to come down. And I think you've made the point that perhaps it's the structure of our labour market, which hasn't allowed us to see inflation fall. So will this prevent the RBA from cutting? Probably just keep a lag going until they can.
Yeah, I think so. And we've been talking about this for quite a while, that Australia will cut, but the rest of the world has to cut first. I keep on looking at that Australian dollar and thinking, hitting around 66, 67, it is. I think the Reserve Bank would like to see that Aussie dollar go up as another headwind. That would become a headwind for imported inflation, but we're just not getting it. And currencies are weak against the US dollar again all around the world. So it's not only Australia. The US dollar has its supremacy, and everyone else is wearing it, which is... for how much longer that goes on, who knows? But at this stage, the US dollar is king. Yeah.
And I think it might well remain that way for a little bit longer. In 2 weeks' time, we've got the US presidential election on the 5th of November. I think the chances now, certainly according to the betting sites and the polls, Trump is favored to win. I don't know that there'll be a red sweep where he gets control of Congress as well, but I think he's very likely to win, and I think the market will take that in its stride, which could mean higher deficits in the future, because Trump is talking about reducing the corporate tax rate from 21 to 15%, which would be very good for corporate earnings, not so good for the federal deficit.
No. It goes back to your point about yields. The long-dated yields are increasing. And if you're right, Paul, that that sort of return for the equity market, which Goldman Sachs is forecasting that we're going to see a lower rate of return from what is a fairly high risk asset, then those sort of yields on long-term bonds become fairly attractive. So let's just see where it goes. I mean, with that sort of long-term bond in the US, 2% above inflation, so reasonably high real yields, that suggests that you might see a bit of buying in the bonds. But your other point is there's an endless supply of bonds being produced by the American government, and there's an endless supply of bonds held by the Federal Reserve, which has to be released, unless they want to hold it forever, which is, I guess, a risk. It is interesting, the bond market is fighting itself to try and work out what fair value is. And how demand supply works out when there's endless supply coming onto the market. And I don't know if there's endless demand for the stuff, but you just watch it. It's quite interesting. I still have the view that quantitative easing will be around and around and around for a long, long time, and manipulating bond yields when they get out of control. But I can see why the bond in America is 4.5%. based on inflation. I don't see how it's 4.5% based on the level of debt in America, the government debt, and the deficits which will come no matter who is the next president.
A couple of other things that we're anticipating in the next week or two. One is that we've got an absolute assurance from Israel that they are going to respond to Iran. I predict that that's going to happen before the US election, and that if anything, that sways voters towards Trump, which I think Israel would be quite happy with. So there's the potential for further flare-up of the war between Israel and Iran, and that could, we've seen a steady increase in the gold price. We're seeing not that much effect on the oil price, which I'm not sure that's a reflection so much of supply as lackluster demand.
Well, I think it's both. I think but the demand is not so much, waning in economic activity around the world. It's just that the world is moving to cleaner energy and at a great rate, and no more so than places like China. So I think we are in this long period of transition to cleaner energy and away from carbon, and the OPEC, and the members of OPEC have got a problem longer term. The smart ones have used the cash and reinvested it in alternatives for their economies. The dumb ones all be caught. And, people make their own assessment of who the dumb ones are.
I think we'll end by reflecting on the reporting season. In the US, it's been pretty good, coming out slightly better than expectations. In Australia, we're going through that period with the AGMs. What are you hearing from companies, and is the confidence out there? Are you getting a generally optimistic read from these reporting results?
You wouldn't say it's optimistic. I think that the competing issues are the Australian economy has grown with population. So there's natural growth and demand just through more, for want of a better word, bums on seats. There's just more people consuming. And so that's driving activity. Per capita income's down, we know that. So you've got those two competing issues. And when you bring in over 1 million people in 3 years, then your employment's going to go up. The numbers of people employed is going to go up. So you've got that. You're looking at those numbers, and economists seem to be confusing themselves, saying, oh, well, the economy's too strong. Well, it's not too strong. It's just growing, given the tailwind of immigration. That's what's happening. It is not too strong to the point where we've got inflation pushing or demand pushing on it. It's just a growing economy, which is growing inside itself. Arguably, we immigrated too many people too quickly, and I think that's what's causing the issues in the property market. But having said that, I think when you talk to business, no one is ecstatic about what they're seeing. They just see, look, there is steady growth in demand across the economy. Inflation issues are waning somewhat. It's highly competitive out there. There is plenty of jobs available if people want to work, and there's still 4% unemployment. So people who don't want to work don't work. I mean, that's Australia today. I just don't think it's anything other than what we used to, but I still maintain Australia's in a growth cycle. The other issue, of course, is the election. Now we're getting closer and closer to the 6-month rally into the run into the election.
Yeah. And
we'll start getting some policies, I guess, from both sides, but it's Australia's bereft of policy outside the debate around energy. There's nothing happening they can't even work out what they're doing on housing. And then but getting back to energy, I just make this final point. I know we've got to wrap up. I just listened to the news this morning about Broken Hill running out of electricity, or its generators are down. You think, well, crikey, haven't they got solar energy out there? Isn't that one place you'd have solar panels?
I wouldn't have thought so.
So, it is extraordinary, Australia. I know there was a storm and it knocked out something down there, transmission-wise and all that. But crikey, you would have thought Broken Hill would have a solar farm out there generating energy, or am I missing something? I would have thought that's the best place for it, but obviously no one else does.
Yeah, yeah. And John, last one, I can't resist this because, as you say, uh, within 6 or 7 months, we'll have to have an election in Australia. There's sure to be lots of chatter still about, negative gearing, taking it on the table, off the table, but also the concessions for capital gains tax, which is halved if you've held it for longer than a year. Is that something that concerns you? And I think Jeff Wilson wrote an article about, taxing gains that haven't been crystallized yet, which is a strong argument. Any comments there before we leave?
It's chaos. I mean, it's a chaotic. Treasury is chaotic in how they put out discussion papers and thought bubbles into the marketplace regarding on changing tax laws. The whole system needs to be changed. I'm not pro or negative anything, but what I am negative is piecemeal changes which have an effect on some other aspect of the taxation regime. There's no doubt that access to debt drives up the price of housing. There's no doubt about it. I don't know why it's a debate. And if you stimulate access to debt by giving interest deductions outside the stream of income, which is the geared income, which is funding the bought asset, then you will create inflation in property. And it's been going on in Australia for 20, 30, 40 years, so nothing's changed. But my only point is, again, it needs Australian taxation system, and it's never going to happen, so let's just be realistic. It needs a total reset. But we haven't got the political will. We haven't got the dynamic leadership in this country to take the country on that journey to do it. So we get this 6-monthly debate about what could happen, and it never does.
Yeah, and just to finish off, I saw a list of home ownership levels, across the world, and Australia actually rates quite poorly. Only 63% of Australians own their own home, compared to a lot of other countries where it's a lot higher. Into the high 60s or low 70s, most of the G7 countries.
Yeah. Well, it's unaffordable. I mean, and it's the most unaffordable housing market, one of the most unaffordable in the world. And we know what happens when that happens. There'll be a correction, and you want to manage the correction and not have the correction overwhelm you in the economy. But so I go back to my original point. There's no attempt by the political leaders to manage the correction in house prices, so we'll wear it when it happens.
Yeah. Probably one of the reasons for that is the concentration in 3 big cities, Sydney, Brisbane and Melbourne, where obviously, capital cities prices are very high. But in the rest of Australia...
Who wants to live in Broken Hill when you can't get electricity? Says it all.
Yeah, exactly.
You've got to have a rural strategy to move cities and move the population into rural areas. You've got to have energy, and you've got to have
infrastructure.
Infrastructure and connection to the internet. I'm sitting on a farm today, and I've been told by Telstra I won't have 4G for a week because they're closing down 3G. I don't know what 4G's got to do with 3G, but that's the sort of nonsense that people in rural communities have to put up with.
Yeah.
And it's not stimulating movement of people and spreading of people across Australia, which Australia desperately needs. It needs 2 or 3 more major cities,
Yeah.
But again, it takes planning, takes foresight. We haven't got it.
No. All right, we'll end it there. John, always good to speak to you. Thank you very much. And we will see everyone next week.
See you.